What we're going to focus on right now is not the lecture explaining capital projects fund, because you guys really can look at that on your own. But we know capital projects funds are used to make sure that the resources that have been assigned or restricted specifically for a purpose, in fact, are being accounted for in that way. So what I think would be helpful is to go through a series of steps or exercises to see the process that occurs, okay? Remember, capital projects funds do not have expenses. They do not have long-term assets, nor do they have long-term liabilities, because they're a modified accrual basis. So let's just take a look at this example. The citizens of Clinton authorized the sale of $50 million in general obligation bonds to finance the construction of a new city hall. The project was expected to cost $60 million, with the additional $10 million financed from a state grant. So basically, what we're looking here to be aware of is we've talked about budgeted journal entries. Journal entries that are specific for the budget get recorded at the beginning of the period. Now, with the Capital Projects Fund, we know the $50 million in general obligation bonds are going to finance the new city hall, $10 million coming in from a state grant. Basically, what we're doing here is summing it up in one. $60 million estimated revenues and other financing sources, and we're crediting appropriations of $60 million. Now, would it have been okay to have said estimated revenues hyphen bonds, $50 million, estimated revenues hyphen state grant, $10 million, and then credit appropriations? Absolutely. We're keeping it simple here.
Okay.
The bottom line is they're all estimated revenues. Paper for Judy. And so the key here, Carmen, what you're saying is right. We're trying, guys, do you remember in for-profit accounting, the first thing you learned is a debit and equals a credit? And so whenever, let's say, when you started Principles 1, when you use cash to buy supplies, instead of going into the detail of a supply or then what type of a supply it is, we just would debit owner's capital. What we were trying to do is, ultimately you knew it was an expense, or you knew it could have possibly been an asset ahead of time, but we were just trying to get some of the basic concepts down before we added a bunch. This is about getting some basic concepts down, but you are ultimately right what you're saying. Number 2, and I'll make this bigger for you. Number 2, the city issued $30 million of bonds at a price of $101. The city received $30.3 million. The premium was to be transferred to the debt service fund. In addition, it incurred $100,000 in issue cost, paid in cash. Now, guys, it's so much easier than what you deal with for-profit and amortization of bonds. We're not messing with that. We're trying to get the basic understanding of the journal entries here. Since it was issued at a premium, that means we received more money than what really the face value was on the bonds. So we're going to show our cash coming in at $30.3 million. We're going to credit other financing source bond proceeds. Why is it other financing source? Because the money's coming in. And then we're showing other financing sources bond premium. It's all from bonds, but just like in for-profit, we like to keep it separate from what the face value is versus what the premium amount is. Because with this capital project fund, we don't want to spend the premium portion. The bonds were created so we are estimating what the project's going to cost based on the face value. So we want to transfer the difference between what it costs, the bond issue costs, and the monies, well, it says here, the premium was transferred to the debt service fund. It didn't say the premium minus the bond issue cost, so ignore, I'm sorry. The premium was transferred over. So do you see how it says other financing use, non-reciprocal transfer to debt service fund? We're showing the transfer of that premium out of the capital projects fund, and we're showing it to go to the debt service fund to help pay the first installment. Then it tells us that it incurred $100,000 in issue costs paid in cash. Here you see it's an expenditure, bond issue costs, and we're crediting cash. Now guys, you will have a problem, and it is in a lecture, where sometimes it will say the bond issue costs, the premium minus the bond issue cost will be transferred over to the debt service fund. If that's the case, then you'll take the premium minus those bond issue costs. Do you see what I'm saying? So just look and see how it's worded. Again, we're keeping it real general here. Any questions so far?
On the middle one, the other financing use non-reciprocal there, is that like a title or a definition or?
Other financing sources and uses, because remember, we really don't have revenues per se, you know, but we transfer monies oftentimes to other places. So we're showing here when the bonds came in, we could show them as bond revenues, but for this purpose, based on all these journal entries, you're going to see financing sources and financing uses, because technically this is how we've chosen to pay for the funding. It really isn't like tax revenues coming in. You know, property taxes or tax revenues are a real a revenue. These are bond proceeds, which is really being used right now as a source of how we're coming up with our money. So yes, use other financing sources, and then when we transfer the premium amount over to the debt service fund, we're going to treat it as other financing uses. Next, the city issued an additional $20 million of bonds at a price of $99, receiving $19.8 million. What does that let us know right now? Is this issued at a premium or a discount? A discount. So we are going to show cash of $19.8 million. We are going to show other financing sources, bond proceeds of $20 million. But guys, guess what? We got to balance it out with our discount, right? Other financing source, bond discount. So basically, don't worry about how discounts are going to be amortized. We don't care about any of that in this class, or premiums. We just want to understand how the journal entries do affect us. The next, do you want me to wait?
Sorry.
No, it's okay. For those of you who have come in a little later, Monday at noon, the cost class has a test. You guys can take that test early, and I can be in the lab at noon. Now, I'm going to probably plan on working for 2 hours, but I know some of you guys can't stay that long, but I like to, you know, you'll get the lectures online, and we're going to be going through chapter 7. I'm hoping to complete as much as I can here. Judy, there are 4 problems for chapter 6's homework. As of now, 3 are online. The 4th one will be online today. So you will be able to go through every one of those problems, and I'm working them through online through the lecture. Okay?
Monday at noon, you said?
Monday at noon. I'll send an email. I just want to confirm that the accounting lab is free. Moving on, the city signed a $58 million contract with a construction company. Guys, is this an accounting event? Not technically.
No.
It's a budgetary event. So we would show encumbrances of 58 million and a credit to reserve for encumbrances of 58 million. Let's look at grants. Oftentimes when the state or the federal government provides a grant, until you have those monies to pay for that grant, you're going to have to treat it as a deferred revenue, because it's not really going to be revenue until you've got that money in place to pay. And you'll have another problem similar to that in the homework. I'm just letting you know why it's a deferred grant. It says here, the city received $8 million of its grants from the state. We'll show cash of $8 million, and we're going to show a deferred revenue grant of $8 million. Now you're going to see something that's going to happen in this next transaction. The city received and paid invoices from the construction company for $40 million. So first of all, we know we received it and we paid it. So $40 million is shown as an expenditure, and we're crediting cash for 40. Now that we've received an invoice, we have to go back to that budgetary entry, don't we?
Yeah.
And we've got to show 40 million of invoices have come in, so we're going to reverse those encumbrances to show what that difference is still outstanding. Then, now that we finally have a bill, guess what we get to do? Reverse the deferred grant to true grant revenues. So you've got 3 transactions here. One is a budgetary transaction that shows an invoice has arrived. We can reverse the encumbrance, that portion of the encumbrance. Number 2, we pay the bill. And number 3, now that we've got those state monies, we can use them. We can reverse, change that deferred revenue to actual revenues, current revenues. Any questions?